are you doing now? Okay, and that's going to help you and me, Mike, to know how to gauge this, how to pace this presentation, find out what folks are doing, what they're not familiar with. So far, I don't have anybody saying options mean like you. We do have a surprising number of folks doing naked calls. We have lots and lots of people doing covered calls. That's interesting. Probably are excited about seeing the technique I'm going to show today about how to take income from a married put trade without selling a call. I'll bet you that's what a lot of folks showed up for. And we're having great participation. I appreciate that, folks. So far, we've got 60% of the vote in, meaning 60% of our participants. Well, that number's down a bit, I guess, because more people came in the room. Okay, around 60%, now 62%, good, have voted. And I appreciate you guys participating with us. Let's leave it up there for another 3 seconds there, Mike, and I'll pause the poll and share the results. Okay, good. And we've got 7 out of 10. It was 88% doing covered calls and naked puts. But this is still pretty heavy representation for the covered calls trade. We've also got an equal number, Mike, doing spread trades and combinations. So pretty cool. And nobody says options mean like you, so we don't have any newbies here. That's good to know, because this thing that I'm going to share today is kind of exciting. It's kind of exciting, but it's going to probably require a double take, and that's why I've actually loaded up 2 different ways of showing the same thing.
Okay.
Dig. Okay, so Mike, let's do this. Let's get into business. See that handsome fella? I'm going to talk to you about our mission, okay, at RadioActive Trading, and Mike's mission over at Power Options. I think, Mike, your mission is similar, okay. Besides helping folks to crunch numbers and helping folks to run searches and find the best trades that fit their parameters, you're also a bit of an education firm, aren't you?
Well, absolutely. If a customer calls up and says, tells me that they're using a set of parameters to identify short strangles, but they're not getting the results they want, well, I'll walk through with them and show them maybe what they might have missed or something that they're missing in the tools themselves, but then I'll also make commentary on, why I personally don't trade that strategy in my account, what they really need to watch out for, make sure that there's nothing there. I don't guide them with their trades, but just strategy specific and ideas and concepts, what's worked for me in the past, what's worked for others investors in the past, and what has gotten people into trouble. So we do all of that here as well.
Right. You don't make straight up recommendations, but what you do is say, folks that are doing the particular strategy that you're in experience these challenges, and they also experience these profits, or not profits. What
is a reasonable expectation if I have a customer who calls up and says they're doing covered calls and they're looking for 1 month out covered call opportunities that have a 15% return if assigned, at least a 20% downside protection. We have to have a small discussion about what is realistic in the market and what can be done, what can be achieved. Absolutely.
Right. So, so we've got a similar mission there, Mike. What I've put up here is the RadioActive Trading mission, and of course, Power Options mission is a bit broader because you encompass more strategies than I do. Our mission, RadioActive Trading, is to provide the best options education possible to help people stay out of trouble. When I first got into trading, my guru, my covered calls trading guru, told me that to really maximize my returns, I had to trade on margin. And so I thought, well, I'll do that. And I promptly got into trouble. I had made some money for a while, and then I got cocky. And that cockiness led me to risk a lot of capital. And I lost it all, and so that was a bad scene. And my mission began when I started blogging back in 2002, saying that, geez, guys, this is what I'm doing. I don't want to get into trouble ever again, and started blogging about different things that I was doing to to learn how to manage risk. And so that's the third part of our mission, is to raise awareness of how the married put strategy, the way that we practice it here at RadioActive Trading, combines position sizing and absolute stops, not a stop order, but a binding legal contract that makes sure that you can get out of your stock at the price that you want to.
A guaranteed exit.
Yes, exactly, a guaranteed exit. But structuring this whole deal so that it allows for income, because I know a lot of folks are digging the idea of income. You know, from, for example, today we've got 71% doing covered calls, right?
Mm-hmm.
And naked puts, which are, you know, very similar. It's the same risk-reward profile, just a different way to set it up, different structure in your account. And then a lot of people are doing spread trades and combinations, which again, generally speaking, it's not a long-term play, right? A spread trade is something where you just expect to take a little bit of income out of the market. So, so that's my mission, is to do that. Okay. Now I want to stop everything for just a second there, Mike,
Mm-hmm.
and call attention to the fact that most of the time, when folks give free webinars, what they're doing is they're giving a little teaser, about 15 minutes of good information, about 30 minutes of entertainment interwoven with that information, and then the rest of their hour-and-a-half deal is a sales pitch. And I want to let you know that that is not our intent here today. Okay, so we're not going to make any special offers. I'm not going to tell you, geez, you know, you've got to get in right now, or it's not going to happen for you. And we're not going to ask you to make any decisions about buying any product that's offered by RadioActive Trading. What we are going to do is provide some real, usable, tradable content, something that's going to make you want to stay on the webinar for the whole dang thing. And we're going to answer some questions too. I think it's going to be a lot of fun. So today we're going to talk about bulletproofing. Mike, what is bulletproofing? What does that mean?
I had a couple discussions about that already this morning. Well, in the context of the married put, we already discussed how we're going to open a new position with a very limited amount at risk, a controlled amount at risk. But what we're going to be able to do is to generate income, and at the moment where we generate enough income where we lower our total cost basis into the position below the guaranteed exit, then that position is bulletproof. Sort of tails we don't lose and heads we still win.
Right. Okay. So so essentially, if you're sitting on a married put position,
Mm-hmm.
and you are able somehow to raise some extra capital, or to you know, what should I say, capture premium. Okay, you're able to capture premium, and then whatever obligations you took on, those are over with.
Mm-hmm.
But now you've got a reduced cost basis on your stock, so now your stock is has a lower cost basis, and your cost basis of your stock and your put option is less than the strike price of the put option. Geez, Mike, can you possibly lose after that?
Well, no. You've got a position where you're guaranteed to make a profit if the stock collapses, and we still have upside potential profit as well.
Right. Now let me be real clear. Circumstances do not always allow for you to bulletproof a stock, but it happens more often than you might think.
Mm-hmm.
And we're not talking about arbitrage here. We're talking about getting into a position that does, at the front end, maybe risk 5 or 6% of the capital that you put into a trade. It's certainly single digits percent, okay, less than 10% of what you put into a trade. But if the stock behaves a certain way, then you're able to bulletproof it. And today we're going to show another way to bulletproof. We showed something on Tuesday, a riskless spread trade, and then on Thursday we showed a different riskless spread trade, and now today I'm going to show a another deal that I think you're going to really dig. Okay, so that's what to expect from today's RadioActiveTrading.com webinar. We're going to have 100% contents. I will point you out to some resources afterwards, but these are free resources, and again, we're going to have fun. Okay, so we already asked folks to introduce themselves as far as what kind of options plays they're doing. I'm going to ask the second question. how happy are we so far? How are we with our trading results? And instead of just saying, yes, I'm happy or no, I'm not, I want to give a spectrum of answers, okay? Spectrum of possible answers, and let our audience have at it. Now, normally, Mike, we see about a 20-80 split, that famed Pareto principle that Italian economist Vilfredo Pareto discovered in the 19th century. He said that 20% of the people usually get 80% of the economic advantages in any socioeconomic situation. And we're seeing something very much like it again today. The first two categories are what we want to be in, right?
That's correct, yes. I would like to be there.
Yeah, we want to say yes. Yeah, yes, I'm very happy with my trading, or hey, I'm happy, but I could stand to be happier, but still, happy. Well, usually the way that this falls out is 20% are in the first two, and 80% are in the last three. And Mike, I'm going to go ahead and it looks like we've got a little bit better results than that in this audience. We've got a combined 25% in the first two lines. Yes, I'm happy with my trading, or I'm happy with my trading, I can stand to be happier. And then the remaining 75% of the audience is various stages of, well, no, I'm not clearly happy.
Right.
I'm not clearly excited about what I'm doing. So, okay, thanks for your participation, folks. I am going to share something with you that I think is going to take you into that 3% category, okay? We'll find out soon enough. In this webinar, I'm making 3 bold promises. Okay, now here are the promises, and at the end, I want you to tell me if I've delivered. Okay, first, I'm going to show you the solution to a big problem that faces buy and holders today. Folks that are sitting on stock, but are faced with the ravages of the market. Okay, I'm willing to bet that you're going to take a look back and wish that you had thought of doing this sooner. I'm going to show you a riskless spread trade, one that's done at a credit. And Mike, it's this particular spread trade that I did back in 2002. I did this publicly, and at that time, folks that were following my blog, I don't think they even called them blogs at the time. I think they still called it web logs. But I had some folks following my blog at the time, and they said, "Hey, have you written a book? Because if you have, I'd like it." So this is actually what prompted the whole RadioActive Trading blueprint. So this credit spread is done at a credit. It normally, Mike, when you do a credit spread, you're doing it thinking that the market is going to do something, right?
Well, it's directional. A bull put credit, bear call credit, for example, we're expecting the stock or the underlying security or the market to do something. It's either stay the same or move down, or stay the same and move up. It has a direction to it.
Right. Well, this is actually not anticipating what may happen. This is the spread trade that's done after the fact, after the market has made a move. Then you do this spread, and it benefits you in the way that I'm going to describe. Okay. So what's really cool about this is that it doesn't use any short calls at all, but it can take your stock and lower the cost basis by taking a credit. No short calls, okay, but it takes credit. Okay, and number 3, something that can happen with this particular play is that you might be able to become bulletproof, which means, like we described a little bit earlier, you've reduced your net cost basis for both your stock and your put to less than what the strike price of the put is. So if the stock continues to move up, you continue to win. And if it moves down, so what? You can't lose. And it's really important to know how to do this just before an earnings announcement or some kind of news event that could send the stock either way. All right. So at the end of the program, I'm going to point out the difference that knowing these 2 techniques means in dollars and cents, and I'll be giving these strategies with no charge. So how cool is that? That's all right, I think. You ready there, Mike?
I am ready, sir. I think our audience is ready as well, and I think they're excited also.
Very good. Okay, we already talked about how happy folks are with their trading results. Okay, and I'm going to suggest that one of the problems is that when we are faced with an expected event, something is going to happen. Either that expected event adds stress to us to where we make poor decisions, okay, or that expected event we don't do anything to prepare for. We just approach it and hope for the best. Hope that that it ends up being a positive thing and not a negative thing. Okay, and well, Mike, I used to have this problem. I don't have this problem anymore. Okay, but have you ever heard this, that in the game of chess, the threat of a move is worse than the move itself? Have you ever heard that say?
Yes, I've heard that phrase before. Sure.
Yeah, and the reason is that let's say I put my queen in a certain position where it could take your rook or it could take your knight. You might make the decision to sacrifice one or the other, and it's the wrong decision.
Yeah.
And all I've done here is I've just introduced a threat. I've introduced something, and because you didn't see it coming, all right, now you're on the defensive, and that's exactly the frame of mind that we're in a lot of the time when we're faced with news events. Okay, so what if it crashes? Well, geez, maybe I just better get out right now. That's the thought. Maybe I just better get out right now. But then if it goes up, what if it blows up in a good way, right? That's just as nagging of a question. Wouldn't you feel like a chump if you sold out just before the earnings announcement that sent it into the stratosphere? Wouldn't you feel silly, Mike, if you were long on Microsoft in the early 80s and said, man, this is as high as it's ever going to go?
Right.
That would not be good. Okay? All right, so we're going to talk about this play that I call the Bulletproof Vest. Okay? I wait for earnings knowing that I may not win, but I cannot lose. Okay, I'm doing another haiku, and I've been inflicting those on you here the last couple of classes, haven't I, Mike?
Yes.
But this is the placid and the contemplative state that I want to be in as that earnings announcement comes forward. I wait for earnings, knowing that I may not win, but I cannot lose. Now, everybody's heard this little chestnut about cutting your losers short and letting your winners run, right?
Yeah, it's a lot like buy low and sell high, isn't it?
Right. It's like, hey, do this and you'll win. But there's not a whole lot of practical instruction that goes along with this. But here's something, a practical thing that you can do, a structure that you can take to hedge your ownership of stock, but that I think does the exact reverse, Mike. It cuts winners short and lets losers run. Would you agree with that?
Yeah, and let's just think about the context. Excuse me, we were talking about if we had a stock, let's say, going to earnings, and we sold a call against it. Well, if the earnings are good and the stock gaps up, well, we've capped our upside gain. We don't take advantage of that movement. However, if it goes the other direction and the stock falls, now we've got an issue, don't we?
Right, yeah. And a lot of folks have come to me with the complaint that, hey, I've sorted winners out of my account, but my account is full of losing stocks.
I'm still trying to repair or get back to square one.
Exactly, that whole stock repair idea. Now, spread trades, they can be structured, Mike, to cut your losers short, but do they allow your winners to run in most cases? I mean, I'm talking about a vertical spread or
well, no.
trade.
No, the winners aren't allowed to run. In this case, looking at a bear call spread, let's say we sold a 50 call and bought a 55. Well, if the stock stays below 50, we make the maximum return. If the stock drops to $1 per share, we don't make any more profit. We still just make the maximum net credit on the position.
Right. Right. If the stock ends up at 50, if it ends up at 49, if it ends up at 48, if it ends up at 1 penny, either way, you were right about the direction, but you don't get to capitalize on the magnitude of that move. You just don't get to pick up the big swing that happens in that stock. So, maybe it cuts losers short as far as having a dialed-in loss limit, but you still don't get to participate in the big moves. Okay, so I got this crazy idea long ago that maybe using a put to hedge my stock was going to help me to catch that big move if that big move was up, and a similar structure could be done to catch a big move if the big move was down, but to cap the possible losses and keep it down in single-digit percents. And so far, that's what I've been doing. So, Mike, I'm going to show the structure of a bulletproof radioactive profit machine. And we're going to go back in time about 5 years, okay? And the reason I'm doing that is not to say, oh, geez, you know, I did this trade once 5 years ago, listen to me. No. I'm using an older trade to demonstrate that these principles are timeless, okay? But we've done trades like this year. Okay? So let's take a look. Research in Motion, Mike, it's 2007, and Research in Motion is trading at 84.04. And the October $85 call, it's very close to, it's just barely out of the money, all right? It's trading at $6.10. Now, what does that hefty premium tell you?
Something's coming up. There's an event coming up. There's something about the stock. The pending event's probably earnings, of course, but it could be anything: patent, lawsuit, rumor of a buyout. But there's some event coming up to why that premium is so inflated. I mean, it's almost an 8 or 9, 7 or 8% return, which isn't necessarily doesn't exist, but this is pretty high for what you'd expect in a normal covered call trade.
Right, $6.10 on $84 stock. That's a very large percentage of what's going on there. That's like 7%, maybe 8%. Okay, so here's the deal, Mike. If I did this, and I didn't do this, okay, but if I did this, if I hedged my purchase of the stock, by the way, I was bullish on it. If I hedged my purchase of the stock by selling an October $85 call, well, I would pick up that $6.10 premium, and that would give me a cost basis now on the stock of $77.94. Okay, so that provides about $6.10 worth of protection, right?
Yes.
Yeah.
To the downside, sure.
Yeah. If the stock goes down to say $78, I'm going to be okay because I've collected these shares. These shares, what am I saying? Premium. I've collected this premium. But it doesn't really provide protection beyond that. Okay? And in truth, Mike, I've played Research in Motion, not this play, but another time. I played Research in Motion another time, and it had a 35% overnight gap. Oh my God. Okay. All right. So would this covered call protect me in that way?
No. I mean, you still keep the $6.10, but the remaining, $10 or so that the stock dropped, you'd suffer that loss.
Right. Okay. So one of the best things that could happen is that the stock only goes up 96 cents. Okay. But I get called out at $85, and I get to keep that whole premium, $7.06 profit. All right. Because my cost basis is $77.94, and I get called out at $85. That would be a 9% profit, okay, in about a 6-week period. Okay, we're looking at September 5th, and then the October calls. So that's about what, 6 weeks, 7 weeks?
Yes, that's right.
Okay, very good. All right, now, that's not what I did. Here's what I did do, Mike. I did pick up the shares of Research in Motion at $84.04, and then I did something that's going to seem a little bit radical. I bought a January 09 $100 put option. Now, that's far out in time, right? More than a year, and it's in the money by almost $16. So is it going to be expensive or really, really cheap?
Well, it looks expensive here, Kurt. You're almost paying essentially a fourth of the cost of the underlying stock to buy this insurance, aren't you?
Right. Now, in a few minutes, I'm going to show the ATM bell curve, and I'm going to demonstrate that this really isn't expensive at all. All right? It really isn't expensive at all, even though it appears to be. It looks like a big amount of money to put into this, but in fact, I'm guaranteed to get most of it back. Most of this $24.70 is guaranteed to be returned to me because, after all, what I've spent in total is $108.74, and the put is a $100 put, right?
That's right. You're guaranteed an exit. The put gives you the right to sell to close your shares of stock at $100 at any time between now and expiration.
Okay, so only $8.74 of that $100 put is really at risk.
Mm-hmm.
$8.74 of this entire investment is all that's at risk. And when you set that against the 108.74 that I've got in, well, that's about the high end of what I ever do want to risk in a stock play. It's 8%. All right, and that's actually a really good money management recommendation by Bill O'Neill. Okay,
Yes.
William O'Neill of Investors Business Daily. Only this is better than a stop order, isn't it?
Right, because if there's a gap, it can't be violated. You're still guaranteed
Right.
the exit at 100.
Right. If research in motion gaps, like it has, gaps by 35%, I still get out with an 8% loss
Mm-hmm.
instead of a 35% loss. Okay, well, here's the deal, okay? 3 weeks into the position, research in motion has gone up, okay? And now the January 09 $100 put option has come down in value, okay? On the previous page, it was $24.70, right?
Mm-hmm.
Let's go back, just make
It
sure.
was $24.70. Yes, it was.
Yeah, $24.70. It was $24.70. Now it's only $19.80. And of course, the reason that that put is coming down, that put is far out in time, and so the reason that it's come down so much in only 3 weeks of time is that the stock has risen quite a bit. Okay, and when the stock rises, all the puts come down.
Mm-hmm.
So here's my spread trade, Mike, and on Tuesday and Thursday last week we did actual nested spread trades. Some folks might argue, well, you're not really doing a spread trade, you're doing a swap. Okay, that's fine. But here's the point. I'm buying one and selling another strike price or expiration month or both.
Mm-hmm.
In this case, I'm selling the January 09 $100 put option, and I'm buying the October 07 $100 put option. Now, I'm spending $7.20 for one. I'm getting $19.80 for another. So, Mike, is this a credit or a debit looked at by itself?
Just by itself, we're generating a credit of about $12.60.
Right. The bottom line, I'm in the black, $12.60 with this trade. Okay.
Mm-hmm.
Okay. Now, in my Options Express account, that was one commission. It was one commission to swap this put for another. Okay. Now, do I still have an insurance policy in place protecting my stock?
Of course. We're still at a 100 put. It's just a shorter time frame, isn't it, Kurt?
That's right. It's just a sooner expiration is all. Okay. And now, here's the deal. I'm doing this because we expect an earnings announcement before October expiration.
Mm-hmm.
So, research in motion, let's do a little recap of where we are so far. I have spent $108.74 to get into the position.
Yes.
By swapping my puts, okay, after the stock makes a move, by swapping the puts, my spread trade brings in $12.60. So that brings my net cost basis, what I've spent so far, to $96.14. So I've got $96.14 in, that's what I've spent, net, and I own 100 shares of stock, and I also own a put option at the $100 strike price. So what's my risk?
Well, now your risk is negative. You've got a negative at risk of $3.86, which means you're bulletproof. You have a guaranteed profit of 386, even if the stock collapses down to $1 per share. But there's something we haven't done.
We haven't sold a call against it.
Right.
We haven't sold a covered call. We haven't done a bear call spread. We haven't done a ratio call spread. We haven't done any of these cool things, these techniques that I've been showing over the last several classes. All right. What we have done is take a credit for adjusting this position. We've taken a credit. We've adjusted the position. Now we're sitting on stock, and we've also got a put option that's protecting that stock. So here's the deal. Without any worries, as my earnings announcement approaches, I sent out an email to the Fusion subscribers and said, I know the future. Now, that's a really funny thing for Kurt Frankenberg to say, isn't it, Mike? How come?
Right, because we always say that we don't know the future, which is why we're using these techniques in the market.
Right. I'm always saying that to people. You know, geez, even after I did a lecture at MIT once, Mike, and the brunt, you know, the thrust of the lecture was that it doesn't matter so much that you are right most of the time picking stocks or timing your trades. What matters is that when you're wrong, you don't get hurt too badly, and when you're right, you allow your winners to run. And still, even after that, I had a PhD come up to me and say, hey, give me a stock. He says, pick a stock for me. I said, you pick a stock. Because I don't know what's going to happen. Nobody knows what's going to happen, all right? But it's funny. I did send out an email to my Fusion subscribers saying, I know the future. Well, here's the future that I knew. I knew that my future the morning after the earnings announcement was going to be good. Okay? Because it doesn't matter what Research in Motion was going to do. Possibility number one, if earnings disappoint and RIM crashes, I'm happy because I've already arranged for a 3.5% profit in a 6-week time frame. That's a pretty good profit in 6 weeks. Okay? I can get out with no problems. I can either sell my stock and my put separately, or I can exercise the put if it's really, really dismally low. All right? No matter what, I'm going to make 3.5%, no matter what.
Right.
Okay? And then the other possibility, of course, was that the earnings announcement was positive news, and it would excite institutional investors, and that volume would shoot through the roof, and more would pick up shares, and that would drive up the price, and that is what happened. I ended up selling my shares at $114.74. So it was a 6-week play. I ended up selling my shares for a 16.23% gain. Now again, if I had sold a covered call, Mike, not only would I not have the protection in a stock that's so volatile that sometimes it loses more than a third of its value, okay, overnight. Not only would I not have protection, but I would also limit my profits to the upside. Okay, so that was the income method number 3, or bulletproof vest. That's what I like to call it. Okay, so we're going to take a few questions. I know that some folks are going to pose this one. Okay, hey, wait a minute. Let me see that again. Exactly how is it that you say you took a credit? How did you take a credit by buying another put option? Okay, so Mike, let's take a couple of questions. And while those questions are firing up, I'm going to also send out another poll. Okay. I'm going to say, if you could, if your trade is like what we showed, would you? No questions coming through, Mike? We got more than 5 dozen people online.
Yeah, I know.
Wow.
I don't have any questions coming in. I had, excuse me, Kurt. I had some conversation earlier on trying to get someone to get their speakers to work. Sounded like everyone else was sound was perfectly fine, so I was working there to try to help one of our attendees get their sound set up. I'm not sure if they got it right, if that was taken care of. But I haven't had any questions.
Well, if questions pop up later on, we'll go ahead and handle them.
Gunter got his issue with the speakers taken care of, but John just wrote in and said, please show the trade again from the beginning.
Okay, well, here's the deal. Here's the deal. I'm not going to do that. What I am going to do is show another trade, okay? And the reason is just time constraints, okay? But I'm going to show another trade utilizing the same principle and doing the same technique. Would that be acceptable?
I believe so. And just to let you know, this is recorded. Oh, here's an important one, a more important one, and it's Deb wants to know, can you do this in an IRA? Yes, everything that we've shown. Everything that we have shown, that Kurt has shown so far, I should say, and most of everything we teach in the blueprint can be done in an IRA account. If you're qualified to trade covered calls and buy puts, you're essentially able to do all of the different income methods that are discussed.
Very good. Okay, so we had some fellow say, and I knew this was going to happen. I knew somebody would say, okay, could you rewind? I knew that. What was the gentleman that said, could you show it again from the beginning?
I believe it was John.
John. Okay, John, check this. I'm going to show it with a different stock along with the principle that makes it work. So I want you to pay real close attention, and we're going to do it again, okay? Because back in 2002, after getting hurt so badly with selling covered calls and selling them, in a margined account, okay, I thought, well, geez, I lost everything, but I didn't lose the lessons. That's what, I'm a martial art instructor, Mike, you know that. And what I say to my young people, and even to my folks that, I train some cage fighters, even folks that go and fight in the cage, I tell them, look, if you lose a match, don't lose the lesson. Don't lose the lesson. You can lose a match. It's not the end of the world. Just don't lose the lesson. There's a reason why you lost, and why don't you figure out what your behavior was that caused that loss to happen. And so here's the deal, Mike. I thought, okay, instead of selling calls to generate income, why don't I buy puts to hedge my losses? But then I also thought, instead of selling front month calls, how about I buy a far out in time put? And then finally, look at this. Instead of selling at the money, how about I buy in the money? And this is the principle of why this works. Mike, what we're looking at right here is what we call the ATM bell curve. And ATM stands for what?
At the money.
At the money. Okay. At the money. Moneyness is it's a principle in options trading that says that the closer to the money that you are, the bigger proportionately your time premium is going to be. For example, if your stock is trading at $45, okay, the time value portion of the $45 call is going to be bigger than the time value portion of the $40 call. But the $40 call is going to cost more, right?
That's right.
It's going to cost more, but the time value portion of it is less. It's less. That works for puts too. If I buy an in-the-money put, okay, if I buy an in-the-money put, I'm spending less money on time value than if I bought it at the money. And this is important, okay, because we've also got a sell zone. This is the buy zone. The sell zone is at the peak, isn't it?
Yes, that's right, Kurt. The sell zone's right at that peak there.
Right. And as I explained with income method number 3, this is a spread trade that's done after the fact. It's done after the market makes a move. The market makes a move, your moneyness increases, and then you take advantage of that move. I'm going to show that exactly in this next play, okay? So, Mike, I'm looking at Altera shares, okay, at $27.35, and a March 2011 $29 put option. So, is it, number one, is it far away in time?
Yes, you're a good, and we're in September here, and you're looking at March, so we're a good six or so months out in time.
Okay, and is it in the money?
Yes, the stock's at $27.35. You're buying a 29 put, so you're $1.65 in the money to start.
Right, and though this $29 put looks expensive with the $3.50 that I'm spending, when you think about it, my total invested amount is $30.85, and I'm guaranteed to get $29 back, right? Because it's a $29 put. Okay, so in effect, it's only $1.85 in time value that I'm spending, right?
Correct.
And if I'm spending that over a period of 6 months, then it's really only about 31 cents a month that I'm insuring this this position to.
About
Pretty
a penny
cool.
a day.
Yeah, about a penny a day for me to have insurance. And by the way, this insurance level is 6%. When you look at it, 185 is the most I could lose, and 30.85 is how much I spent to get in. So the most that I could lose is 6%. Pretty cool?
Mm-hmm.
All right. Now, just before I show the mechanics, of the Bulletproof Vest again, what I want to do is just do another poll, okay? I'm going to say, if you could go back in time and change whatever your losses were last year to 6% or less, would you do it? Okay? And Mike, in truth, I'm showing this with 100 shares and 1 put, but what I did was actually do this with 500 shares and 5 puts, because then that puts at risk $1.85 a share times 500, or $9.25.
Mm-hmm.
And I was trading in an account that was worth slightly more than $100,000. So if I can only lose $925 and I've got 100 grand, what's my risk to my portfolio?
Well, it's under 1% now, isn't it?
Right. Okay. So I'm going to ask everybody, if you could go back in time and change your losses, okay, from last year to 6% or less in each trade, or 1% of your portfolio, would you do it? Would you do that? And this is a question, Mike, that actually teaches a lesson.
Mm-hmm.
I'm kind of mimicking Socrates here. I'm trying to, not that I'm as cool or wise as Socrates was, but his teaching method was that he would ask his pupils questions and they would come up with their own ideas. Okay? All right. So, and there's really only 2 ways that you go. It's, yeah, I would go back and do that, or, you know what, I did do that, and I still need some help.
Mm-hmm.
Okay? So let's leave that pull up for another 3 or 4 seconds. If you haven't had your voice heard, please do so. Okay. And close. 94% of our audience, 94% say it would make a real dollar difference if I did that. I should say 94% of those that voted, because not everybody voted, but more than half voted, okay? More than half our audience. 94% say it would make a real dollar difference if I did that. Well, I've got a question for you, 94%, okay? If I ask the same question next year, what will your answer be? If I ask the same question, you know, if I said, are you glad that you kept your losses down to 6%? What do you think your answer will be then?
Mm-hmm.
I think probably most of you will say yeah. Now, 6% said, you know what, I did manage my losses to 1%, and I still need help. Okay, good. Well, that's what the income methods are all about. Okay, so let me go ahead and share that. Okay, Mike, are we back on our regular screen?
Yes, sir, we are. We're looking at the 5-line setup for the Altera position.
Okay, so we've got the 5-line setup, right? The stock, the put, the total invested between the two, the strike price, the difference between the strike price and what we've invested being less than 10%, in this case 6%. Okay, now here's the phenomenon at work that John wants to see again. The phenomenon is this, that the puts price did go down, all right? The puts price went down as the stock went up, okay? And it had been $3.50. Guess what? Now it's $2.52, so it's gone down by 98 cents. In order to do that, Mike, the stock had to go up by $2.05. Okay? So here's the deal. Altera shares had been worth $27.35 and the put had been worth $3.50. And what I had spent was $30.85. With me so far?
With you so far.
Okay. So on October 15th, all right, about a month later, here's where we were. The stock had risen by $2.05, so now it's at $27.35. And The March 2011 put option is worth 252. Okay, it's come down in value. Now, I want to point out two things here, Mike. First of all, I want to point out that what most people would say the break-even is on this trade is what?
30.85, and they would be correct if the position was held all the way to expiration.
Right. Actually, three things have to happen for me to lose at below 30.85. Okay. The three things that have to happen are, number one, the stock has to be trading below 30.85.
Yes.
Number two, I have to have made no adjustments.
Right.
And number three, I have to hold it all the way
To March expiration. Yep.
Yeah. Now, I'm in control of two out of those three factors. I'm in control of whether or not I make an adjustment, right? And I'm in control of whether or not I want to hold it all the way till the end. I might just sell the stock and the put separately and take in more. So that's okay. All right, but 30.85 is technically the break even. I want you to remember that number because here in a minute that's going to go away. Now here's the other thing I wanted to show you. Okay, 31.92 is now the net value of my married put. So it's gone up in value by how much? Let's see. 30.85 is how much I spent. Yep. $1.07 net gain in value. Okay, now looking at just that, $1.07 net gain in value, let's see what happens next. Okay, first of all, the put price has gone from 350 to 252, but as the put comes down in price, it's because the stock is going up in price, right?
That's right.
Right. Okay. And any loss in the intrinsic value is offset by the stock's gain. So all this brown stuff that goes away, right, that's $1.65 worth of intrinsic value, that $1.65 went away because the stock went up $2.05. Okay? So there's really no loss. There's no net loss, even though the put goes down. Okay? But let's talk about how it went down. It went down in absolute value, but did it go down in time value?
Well, no. It's an interesting phenomenon of the ATM bell curve that the time value or the extrinsic value actually swelled as the option went from in the money to at the money.
Right. See, it was in late 2002, early 2003 when I started writing about this phenomenon that folks started asking, hey, dude, have you written a book? Because you know, it's kind of slick. I mean, here's the deal. I'm swapping one put for another, taking income, and doing pretty good. You see, now it's in the sell zone. That $29 put, when the stock is at $29.40, the $29 put option is the closest to being at the money, right?
Yes.
And what I'm going to do is I'm going to sell that $29 put option. And here's how I do it, okay? I sell the $29 put option, and in its place by the November, and I'm not saying November further out, Mike, it's November close to RIMM. November $30 put option, okay? So this is the March 2011 put, and I'm buying the November 2010 put, okay, for $30. Now, first of all, is this a credit or a debit?
Well, again, you're creating a credit. You're creating premium on this position by selling to close the one and buying to open the other at a lower price. It's a 90-cent net credit.
Okay. Let me point something else out. This this $30 put, okay, is down on the buy side, not the sell zone, but it's on the buy side. Hang on just a second. There we go. The buy side of the ATM bell curve. It's in the money, right? When the stock is $29.40, then the $30 put is going to be in the money. So what I'm doing is I'm swapping an at-the-money put for an in-the-money put. It's closer in time and therefore cheaper. Okay?
Yes.
So I take a credit. But that credit is taken while raising the payout by $1. That's really significant, isn't it? Because when you think about it, before we saw $1.07 net gain in the stock, right?
Mm-hmm.
In the stock and the put, $1.07. Well, here what I'm doing is I'm taking a 90-cent credit to raise the payout by $1. So doing income method number 3, the Bulletproof Vest here, actually improves my position.
Mm-hmm.
I'm doing better than the $1.07 credit of just selling the position. Now instead of selling the position, I'm adjusting the position. And check this out. After income method number 3, $30.85 is what I had spent for the put in the first place, but 90 cents credit is what's taken.
Mm-hmm.
So what's the net cost for my stock plus my put option?
Well, now we've lowered the total effective cost basis of the position down to $29.95.
Right. And it's a $30 put.
That's right. Now we have a $30 put in place. So we have a guaranteed exit or a guaranteed profit of 5 cents, even if the stock collapsed to 1 cent per share. But going forward, we haven't limited our risk we haven't limited our gains on the upside.
Right. That's the most significant part. The most significant part is not the bulletproofing. The significant part is that we've got unlimited upside. Can't get hurt to the downside. So it's heads I don't lose,
Mm-hmm.
tails I win. Heads I win, tails I don't lose. I mean, whatever. I'm not going to get hurt, okay, and yet have a game. So, yeah, that's an exciting place to be. And hopefully, running through that the second time, that helped John with his questions, okay, and also showing the principles, okay, the principle of the ATM bell curve.
Yeah, that's
right?
very important because it's not at first for an options trader, anyone who's been trading for a few years. I mean, you've probably seen it in your trades. You get that frustration maybe when you sell an out-of-the-money call for 40 cents and the stock moves up. You only have 2 weeks left to expiration, but now it's at the money, and it's going to cost you $1 to buy it back. You get frustrated with that. But when it's the other way, when you're actually buying it for a proper hedge, insurance, where you're buying an option for insurance, it's interesting how buying it in the money, as it swells up, you actually gain in the time value portion of that option. That extrinsic value swells.
Yeah, and a lot of folks don't get that, especially since time has gone by.
Mm-hmm.
They're thinking, man, time went by, but the time value increased? What's going on? It's really exciting, and it has to do with the ATM bell curve. Mike, the new position looks like this, okay, and this is actually a different position. This is RCI, which another subscriber named Ravi had written in with a question on how to bulletproof this. And we showed him how to bulletproof it with zero cost,
Mm-hmm.
but that was a special situation. But here's the deal. It's the married put graph, right, but there's something missing. What's missing?
Well, there's no red. There's no loss. There's no break even.
There's no break-even line. It's essentially, look, you're going to either make money or you're going to make a lot, and we don't know what's going to happen. Don't know what the market will do, but we do know that what we've done is bulletproof ourselves. Now, last week we showed another riskless nested spread trade. Here's another spread trade that is missing a break-even curve.
Mm-hmm.
And the reason it's missing a break-even curve is because of the context in which we did it. Owning Visa at a lower cost basis and then doing a ratio call spread and a put in that context. And this is what RadioActive Trading is all about, is teaching folks how to limit their risk or make it disappear, but at the same time still have the potential, not the guarantee, okay, but the potential to make some money. Okay, so the income methods are used to reduce the break-even. You saw my Altera trade where I began with a 6% risk. I absolutely could have lost 6%, right?
That's right, Kurt. Yes, the $1.85 and the 6% at risk. Yep.
Yeah, but our audience has said that I would do that. Most of our audience is saying, yeah. If I could go back in time and make that what my trading was all about last year, I would. Okay, so why not make your next 12 months of trading this way? Why not learn to keep yourself out of trouble from the and then after that, apply the income methods, okay? Because the income methods will reduce that break even, and in fact, it may help you to reduce the gap to less than 0. Now again, this doesn't always happen, but when the right conditions manifest, you can use one or more of several different methods, and we're going to explore even another method on Thursday, aren't we, Mike?
That's right. That's right. A different adjustment using the put option there as well.
Right. Mike is going to show income method number 4, which is really cool. I call it the ATM machine. And we call it that because it uses the ATM bell curve, but I also call it the ATM machine because you got to prime the pump. You have to put some dollars in to get more out, just like a real ATM machine. Okay, so just a summary of what we did today here, Mike. Okay, what was the problem? The problem was there's a dang earnings announcement coming up, and we don't know if that's going to make things go bad. Okay, that was the problem. So what's possible? Well, what's possible is you could build a fence around the stock to begin with. That's the way that I advocate doing any kind of trading, is to use options to hedge it. Keep your risks down to single-digit percents. Okay, but you might also be able to bulletproof your stock, and with a smaller move than you would think. Mike, with $30.85 invested, most folks think that I can't make a dime until the stock is at $30.95. But when the stock was at $29.40, that's when I bulletproofed it and guaranteed myself a gain.
Right.
All right, so it could be a smaller move than you think before you bulletproof. Okay, so that's what's possible. Well, what's different now? What's different afterwards? Well, you may cash in your stock at a protected price no matter what happens to your downside. If the stock does gap down, even precipitously, even if it goes down really hard, so what? You're protected. That's the idea. Okay, and if your stock goes up, well, so does your profit, and that's a happy thing. We like that. Okay. Finally, what should I do now? Well, what would you do? I would say get as much more education, get as much as you possibly can. And we did have folks wanting to rewind, and pause, rewind, replay. You know, show me that again, would you? And I kind of anticipated that today. I knew that that was going to happen, and indeed, John piped up and said, "Hey, could you show that again from the beginning?" Here's the deal: go to the webcast or the podcast archive on RadioActiveTrading.com. It's free. That's one of the free resources I'm going to point you out to. Okay. And Mike, were you going to pipe in, or did you have a question?
Sorry, I had to go on mute for a moment there. Had to sneeze. Sorry.
Oh, I heard you breathe in, and I thought it was that breath that you take before you want to say something, but it was another thing that you were doing, right? Gonna sneeze. Okay. Well, here's the other thing I'd recommend: get the right tools. Okay, get as much education as you can, and get the right tools. Okay, and keep coming. Here's the last thing I'm going to say. Keep coming. You know, we're going to have another one of these free presentations on Thursday. We're going to show something completely different than we did last Thursday, and completely different than we did last Tuesday, and completely different than what we did today. All right? So, and consider bringing a friend. You know, if you're pleased with the risk limiting and income-producing techniques that I'm showing you, and you think that they're maybe worth a little more to you than what you picked up in a $3,000 weekend, right?
Right.
Come to this thing for free. Do it, okay? And bring a friend with you, okay? So that's what I was going to mention. We do have a number of different types of trades that can be done to mitigate risk or to eliminate risk. And in fact, it's possible at certain junctures to have a trade like this where you can't possibly lose. It's just uncertain how much you'll gain. Okay? So get as much free information as you can. And the next best thing to free is worth it. You know, I mean, when you spend money, for God's sake, make sure that you spend money on a course or an event or something where you have a money-back guarantee. Okay? I didn't do that. I went to one of these weekend courses for $3,500, that not only was I out that money, but I also lost quite a bit in the market.
Mm-hmm.
Okay, so get as much knowledge as possible. That's what I'm going to say. So, so one free resource is the webinar podcast archives on RadioActiveTrading.com, and I'm going to say that every graph that I showed today was using the Power Options tools, and I'm going to recommend that you try a free 2-week trial of Power Options at www.powerop.com/RAT for radioactive trading, and I'm sending that link to the audience now.
Okay.
Okay, so that's the whole dog and pony show there, Mike. Did any questions come through that we didn't handle? Because I'd like to go ahead and handle that real quick before we sign off.
Okay, I did answer. Real quick, I'll just give the statistics on this. Lloyd asked, what time was the ALTR trade closed and why? And well, Kurt, you closed the ALTR trade on November 19th, 2010, when that put hit expiration after that last income method number 3. And really, the reason why it was closed, it was an 11.9% gain. The reason why it was closed is because you had met your goals for the position. Each investor has their own goals, and when we get into an RPM, we have our goals set out of what we're looking to do and what we want to do, and that was that position. John asked, what effect, if any, does volatility have on this trade? And the way I answered, John, was that once you're bulletproof, the volatility really doesn't affect it, meaning that, yes, the put option might move up and down in price as the implied volatility swells or as it decreases. You may see the put option move a little bit side to side. That might affect your liquidation value, but remember that once you're bulletproof, that's a guaranteed exit. That's not going to change. Once I have that cost basis below my put strike price, I'm guaranteed at least that. I'm guaranteed to make that at least, and then I still have potentially the unlimited upside. Also, I'll say that using the Power Option search, of course, is it possible that you could find a position that has an inflated implied volatility, and that would increase the risk? Yes, but based on how we do our approach, how we use the information in the book, I'm not allowed to mention this webinar because it's not a sales pitch, and the tools on Power Options, you wouldn't see those anyway because the risk would be too high. So anything that has too high of an implied volatility, you would have automatically filtered that out. You wouldn't even be seeing those at all.
Right. The cardinal rule of keeping your risk down to single-digit percents would just kind of filter out a bad trade.
That's right.
Yeah. If the implied volatility is too high, you just wouldn't get in.
That's right.
That's real simple.
Right.
Yeah.
And the last question that's important to ask, Frank and I had a discussion earlier. He says, well, you're cutting into your profits by doing this insurance. Well, yeah, if I knew the stock, for example, in the ALTR position, Kurt, if we knew the stock in a 30-day time period or a 40-day time period was going to go from 27.35 to 29.50, was it, or 29.80, we might have played it differently. But, of course, if we knew that, then there wouldn't be a market. It would already be priced in at that time. But Frank also asked, is it possible to do this with only using options and no stocks? And Kurt discusses that a little bit, but the minute you start using leverage, the minute you start to try to mimic a position using a leverage to use less capital, you're naturally changing the risk-reward profile. You might have a similar risk-reward graph, but the rights and obligations become different. And, we get a lot of questions, Kurt, don't we? Well, what if I wanted to save money and I bought an in-the-money long call and the in-the-money put as well instead of buying stock? Well, now you're creating an in-the-money long strangle, which has a completely different risk-reward profile. You're still risking maybe 30-40% of what you invested. There's the risk of overtrading, and there's a dynamic there where in a normal market condition, the RPM will show a profit. Let's say if the stock in general just moves up 5% or so in the first 30 to 60 days as we're expecting, we'll have a profit on the married put. You're most likely still losing on that in-the-money long strangle.
Yeah, it's a really strange day when we don't get a question from somebody saying, hey, could you just do this without buying stock? And the point is, we had 94% of our audience that answered that poll question. If you could limit your losses down to 6% or less, would you? We had 94% say yes.
Mm-hmm.
Okay, but then somebody, maybe within that 94% or without it, on the outside of that 94%, somebody says, well, can I leverage myself a little more? Can I take a bigger position, with less capital?
Mm-hmm.
Well, dude, what you're doing is starting to shoot yourself in the foot, because what you're doing now is leveraging yourself. Listen, I'm a martial art instructor, okay? I've been doing this for over 30 years. I'm a grandpa. But if a 20-something dude walks into my studio and he has 50 pounds on me, I can still play with that kid like a cat does with a ball of string,
Mm-hmm.
because I understand the principles of leverage. All right? Because I understand the principles of leverage, I can kill that dude.
Mm-hmm.
I can really embarrass him in front of his mates, if he's going to come in with an attitude. But after gaining his respect, guess what? I'm able to teach him. And then 6 months down the line, he understands some of the same principles of leverage and skill that I do. Now I've got a problem. Now I've got a fight on my hands.
Mm-hmm.
Okay? Now this is a long, long way for me to say that the market is a 600-pound gorilla that's pissed off at you and has leverage. If you want to play leverage with the market, you're going to eventually get caught. You're going to eventually get killed. Okay, so I'm going to say try what we're showing you here first. Even just paper trading. Try that first and see if you don't limit your losses really well and give yourself the opportunity to gain. I've demonstrated in my account that it's possible to lose more often than you win, but still make money. And that's kind of an interesting proposition.
And there's no other strategy I know of in the market where you can, no other option strategy I know of where you could actually do that. Most require that you're right 75, 80, or even 90% of the time in order to make profits long term.
Well, let's talk the language of most of our traders today. We have 71% doing covered calls. Mike, is it possible to be right 4 times in a row and then be wrong once with the cover call trade and then erase all of your profits?
Exactly. It is, because in general, if I'm looking for a reasonable, let's say, covered call, I'm looking for good quality stocks that show, good positions, and I'm looking for, quality stocks. But, what we're talking about here is maybe an at-the-money call. I'm looking for maybe a 3% return if assigned with maybe a 4 or 5% downside protection, or maybe a little bit more, let's say even 4% assigned. So my first 4 trades, I invest the same amount of money. I make 4%. We've essentially made 16% total if we just add that up. On the 5th trade, I put in the same amount of money, but the stock has a collapse and drops 35%. Let's say it even drops 30% overnight. What ends up happening? Well, any stop loss I had in there is violated. I get closed out for 30%. Now overall, I'm at a 14% loss. We were right 80% of the time, but I've got a 14% loss in my positions.
Right most of the time, and still lose money.
I got to answer this, and I got to break the rule, Kurt, and you're going to hate me for doing this, but I apologize. But I feel that, I'm kind of hindered with the explanation here, and we talk about this. Deb asks, can you add a FAR OTM call to add some income? Well, yeah, that's income method number 1. That's one of the 10 income methods. Doesn't necessarily have to be deep out of the money. There's a correct way and an incorrect way to use income method number 1 in all of the 10 income methods, and that's explained, of course, in the full work. And Gunter asks, do you still try to trade with an uptrend? Yeah, I mean, when we're looking for new positions, I'm looking for stocks that I feel are going to have a potential. There are ways, of course, to approach this in a bearish market, and there are some of those 10 adjustments I just mentioned. Some of them work if the stock stagnates or has fallen in price. They're not all based on the stock moving up.
Very good.
But those are the best ones.
Okay. All right, Mike, I'm going to call it. I think that's